Hello, good evening. Welcome everyone. Good evening, welcome. Happy St. Patty's Day. I want to go a different direction. Many of you are dressed for the occasion, we appreciate that. I am, of course, not, because I can't remember those things first thing in the morning, but I'm Ted Bavard, alongside Mike Blehar, and of course, the man of the hour, Charlie Smith. So glad to actually be here and see so many of you in person, finally. Been a long 2 years, a long 2 years. Tonight's a special night for us. We get a chance to celebrate my dear friend and partner, Charlie Smith. It's going to be difficult, I have very little to say, but Carrie said if I stick something sharp in my hand, I can get through it. Carrie, where was that? You have it? Ugh. I didn't bring it up here. It's tough. The three of us have been together for over 30 years. 30 years. Not just working together. Thank you. You think about how unusual, how special that is to not only have the 30 years of working together, but 30 years of being friends, and still friends. That's actually much more unusual. So, Charlie, I'm going to be short and sweet, so I can get through this. But thank you for all you've meant to all the people here, to me and my family, for all the things you've done, for your trust and your friendship. It has been an honor. Thanks, Mike.
I'll just stay over here. I'll get through my piece. Short and sweet. We were thinking about a roast, but that would take the whole night. So you weigh a lot of material, and then I would offend people and get in trouble with compliance. So I have to say this. I met Charlie when I was 32. On March 28th, I'll be 62. I know I don't look like it, but I will be 62. You do. All right. So that's 30 years as a partnership. And in business, a 30-year partnership is hard to come by because there's all kinds of things that take it sideways. It could be greed. It could be ego. It could be mistrust. It could be somebody not pulling their weight. Okay? So how special is this? That for 30 years, we've been together with complete trust for each other, everybody pulling their weight, nobody got greedy, no ego. And that is a special success story. And I can't think of better people to have gone through this with than Ted and Charlie. Charlie's done so much for this firm, so much for all of us in the room. He helped us all get more wealthy, of course, okay? But even though this business relationship is winding down, the friendship will last forever. And we appreciate everything you've done. Now we get to turn it over to Charlie.
Wow. Thank you both. Wonderful business partners over 30 years. As you said, Mike, it's something special, something unusual. We were able to subjugate the egos and make it work. We trusted each other. We let each other do our jobs, and we kept at it. Something to be said for persistence, effort, trust, and compassion when it's not going right, to know that your partners are making the effort to make it go right. And you guys both did that. So thank you. Welcome. What a wonderful evening this is for me. It's great to get everybody back together after 2 years of pain. It is a special treat to be able to say to all of you, thank you for your trust and confidence in what we've been able to do over the last 27 years at Fort Pitt Capital. We've made the effort to try to be honest, tell you what we really think, rather than telling you, what the market and the sales crew would like you to hear. Our job is to give you the straight skinny and let you know what we really think, and I think we've done that. Now, brevity being the soul of wit, I'm going to be brief. First comment is about the tuxedo. A bit of a brief math lesson. I've calculated that for about 5,000 days, these guys let me avoid wearing a suit to the office. So 3 hours in a tux equals 5,000 days of not wearing a suit. So that's the new math, folks. Get used to it. What do you want in your money manager? What is the skill set that makes the person who's running your money successful and compatible with what you need? Temperament, after thinking about it for 30-some years, to my mind, is paramount. You need a temperament. You need a person who is able and willing to think rationally in a composed manner about everything that's happening and, frankly, avoid the noise as much as possible. But temperament, to me, is number one. And number two is curiosity. My wife has often told me that I'm a know-it-all. And I say to her, that's my job, honey. But to actually want to be a know-it-all is an important component of managing money. Because frankly, knowing something that someone else doesn't know, or before someone else knows it, or recognizes it, or crystallizes it in their mind, is the difference between success, one of the differences between success and failure in investing. So the proper temperament, the ability to be a rational thinker, and an intense curiosity about the world are the two ingredients that I think are absolutely required for success as a money manager. And in the folks that we are bringing on to take over my role, we have those ingredients in spades. Dan I has been working with me now since late 2018, I guess it is, 2017. And he demonstrates to me a commitment and a mindset to an even temperament that gives me the confidence that he can carry on the approach that we've espoused for 27 years now. Right after COVID hit, Dan wrote a piece for our quarterly newsletter entitled, "The Market Doesn't Wait." And that mode of thinking, that mindset during that period made you all some serious money. And a level head and the ability to think for yourself when the rest of the world is losing their minds is key. Carter Henderson has an intense curiosity about the world. He wants to know what every company is doing at all times. He has a retail background that tells me that the Peter Lynch theory of know the businesses that you invest in as personally and as closely as you can is going to work. So that combination of an even temperament and intense curiosity is evident in both these gentlemen. And I'm perfectly happy to be turning over the portfolios, as I've already done in most cases, 90% of the cases, to these two gentlemen. I wanted to sort of distill what I've learned in actually 39 years in the investment business to a few basics. I don't know if it'll help any of you think about the world and think about the world of investing. But I've learned that the equity premium, the premium return that you get from being an owner of a business is real. No matter how much Wall Street and the sales engine that is the market will try to tell you otherwise, focusing on real businesses and real people making real products and the success and or failure of those products over time is the main chance in investing. It's the be-all and end-all of investing. People go to work, millions of people go to work every day around the world to try to add value to their enterprise. In the US, we have liquid and deep capital markets that allow us to participate in those enterprises. And if we can do it in such a manner that we can avoid the noise that Wall Street is purposely creating to try to distract us, we're going to do just fine as investors. Diversify, but don't over-diversify. I see portfolios today with hundreds of stocks in them, and I wonder, why are you even bothering? You can build a portfolio of 25 to 35 businesses and in diverse industries, and you will remove 95% of the risk of any one of those businesses wrecking your results. So diversify, but don't push it beyond 25 or 35 companies. Finally, as a value investor, as an old Scotsman, I recognized over 30-some years that the risk is always in the price that you pay for an investment. There is literally no price low enough that you can pay for a business that doesn't discount every single risk in that business. If you can get a business at a low enough price, you will have removed the entirety of the risk from that proposition. The risk is always in the price, and we're always able to not only recognize a decent business, but be patient and willing to wait to buy it at our price. The single biggest mistake that retail investors make is they recognize good businesses, but they're unwilling to be patient enough to buy those businesses at a price which makes them a good investment for them. And so the risk is always in the price, and that's where the value style, the value approach that we've espoused my entire career comes from. There's an old saying on Wall Street, if you don't know who you are, Wall Street's a very, very expensive place to find out. And so we've known who we are for probably the last 25 years of my career. Probably the first 5 years, I had no idea what I was doing. I'll freely admit that. But the last 25, I think I've figured a few things out. And so that process is what allowed me to help you folks in building your wealth. I consider it a privilege. I want to thank all the people at Fort Pitt Capital Group that helped me along the road. It's been a great ride. I want to say thank you to each and every one of you. Finally, I want to thank my wife, Barbara. She's put up with a lot, but we made it through. I don't have big plans for retirement. If you're a fan of YouTube, Google something called a forestry mulcher. I've got 35 acres in Marshall Township that I plan to turn into a park for my grandkids, so that's going to be my retirement. Thank you.
Good evening, everybody. That's going to be a very tough act to follow. Happy St. Patrick's Day. I almost, Ted, you almost messed me up. I was going to say Happy Thanksgiving. For those, I would just want to echo too that it is so wonderful to see so many people in one place again. I'm sure we all really missed that. And so thank you for, you have a lot of options. There's St. Patrick's Day, March Madness. You got a lot of things that you could have been doing tonight. We appreciate that you were spending that time with us. So for those that don't know, my name is Bill Engel. I'm one of the advisors here at Fort Pitt Capital Group. And I have the privilege tonight of introducing our program and our guest speakers. We'll give you a recap of the market in 2021. We'll give you an outlook for 2022. We'll have some time for questions and answers, and then dinner will be served, and we'll be able to get on with the party. I have, before the introductions, I have 5 items of housekeeping, and I want to make sure that I get through them all. So the first is validation. You all are great. Just kidding. Parking validation. If you parked in the Westin Hotel parking garage, please on your way out, make sure that you stop at the registration table and get a validation card. Also on your way out, tonight we have a wonderful special gift to all of you, courtesy of our very good friends at the Gould Family Vineyards. We have a custom private label bottle of wine. Now, you may have noticed by looking around, it's a crowded party tonight. We have our largest group ever. I think we had 427 RSVPs, which is wonderful. Yes, thank you. We brought 1 bottle for each of you. So please, just 1 bottle on your way out, and then and enjoy that. But wait till you get home. The next item is dinner. So right as we wrap up the question and answer, dinner will be served. It is a duo plate this evening, filet and halibut. Sounds wonderful. I'm sure it's wonderful. If you would prefer a vegetarian option, we'd be happy to accommodate. Just grab your server as they're coming around and letting them know that you would prefer that. I'm sure that's wonderful too. 4th item, on each table, there is a beautiful floral arrangement, centerpiece. Please feel free to take that home as well. Now, you'll notice there's only 1. So it is customary that the eldest female at each table gets first right of refusal. If she doesn't want it, then you can arm wrestle or but please enjoy that and take that home. Where am I on? 4? Item 4? Okay. What is item 4? I gotta cheat. I distracted myself for item 4. No, that was item 4. Item 5, actually the most important. So as I mentioned, it is St. Patrick's Day. It is March Madness. Very likely that there will be shenanigans out there, particularly on the roads. So please, we just ask, because we care very much about each one here, be cautious and careful on your ride home, because there are going to be some wacky folks out there. So please be careful. Now, allow me to introduce our speakers for this evening. Jay Somariva. He is managing partner of the firm and head of asset management. Jay has 28 years of industry experience, about 20 of which was with BNY Mellon and Northern Trust. Jay is our resident expert on fixed income, interest rate policy, and general economic activity. Dan I, our Chief Investment Officer. Dan comes to us with about 20 years of investment experience, he said. Perhaps experiments. And prior to joining the firm, he was the chief investment officer at Roof Advisors. And then, as Charlie indicated, for the past 3 years, he worked side by side with Charlie and was Charlie's handpicked successor. So without further ado, help me welcome Jay and Dan.
All right. Thanks, everybody. Good evening. It's great to be with everybody. I'm really glad that we can do this, in person this year. So I'm planning on starting off with a bit of a market recap, talk about some of the events and developments that have led us up to this point. Then we'll pivot and talk about, some of the issues that we see unfolding in 2022, and we'll wrap up with our outlook for the year. So I think a good place to start the conversation is with a focus on, the main driver of the U.S. economy, the consumer, and a really strong picture here. Consumers in good position, and we can see that if we look at their balance sheet, or as we show on our chart here, their low levels of debt service obligations in comparison to their income. That's, at the best levels in more than 40 years. The consumer is also, sitting on a massive, $2 trillion in savings. So strong consumer. We think that acts as a cushion, for some of the challenges that we see unfolding in 22. This is a look at how different segments of our economy have recovered since the COVID pandemic lows or the shutdown lows in the first quarter of 2020. And we can see that, consumer spending, consumer transactions are well above even pre-pandemic levels. Dining activity has fully recovered, and even some of the most sensitive areas of our economy, like air travel and hotels, are almost back to normal. So I think the real title of this chart should be just don't bet against the U.S. consumer for any extended period of time. Here we take a look at U.S. GDP starting in early 2000, and we can see that even after the biggest, most significant economic contraction or recession since the Great Depression, we're now right back to levels where the economy would have been even if we didn't have the recession, and instead just continued to grow at long-term, trends. So I think it's a really good picture of how, resilient the economy has been. Corporate earnings, an area where we spend a lot of our time focusing, have also been a bright spot. We saw, S&P 500 companies grow their earnings at close to 50% last year compared to 2020 levels. And estimates for this year, look healthy as well, currently calling for about 8 or 9% earnings growth. So a very strong picture. But as encouraged as we've been with, the economic rebound and the strength in earnings, we also have to mention some of the other factors that have driven, stock market returns over the last few years. One being extremely low interest rates. So here we show the yield on a 10-year Treasury bond as a bit of a proxy for the overall, interest rate environment. And we can see that interest rates have averaged about, 1.5% over the last 3 years, very low. That's certainly driven stock market returns or propelled stock market returns, have supported equity market valuations, and it's really translated into, stocks being the only game in town given such low yields in the bond market and return opportunities in other asset classes. Probably the biggest understatement I'll make tonight is that the Federal Reserve has also been a huge tailwind to equity markets. And not just by setting, interest rates at zero over the last couple of years, but also, their very aggressive quantitative easing or bond buying program, which saw, for most of the last 2 years, the Fed buying, $120 billion worth of bonds every single month, which, pumped massive amounts of liquidity into financial markets and translated into, a $5 trillion increase in the size of their balance sheets. And we can see the green arrow here on our chart. You could certainly overlay the performance of the stock market right in line with the increase in their balance sheet. Consumers and the economy have been, really well supported and backstopped by, more than $3.5 trillion in fiscal stimulus, which has resulted in, very elevated federal budget deficits. And not, in our opinion, a lot of this cash worked its way into equity markets and really, added to some of the speculative froth that we saw really peak out over the summertime of last year. So, putting all these, very supportive tailwinds together, this has really been the outcome. Over the last 3 years, the broad equity market or the S&P 500 has advanced by, 100%, which works out to, a 3-year annualized return of over 26%. So that's not just a little bit above, long-term historical average returns. It's about 2.5 times, those longer-term average returns. So I think the question that this chart really sets up is, have the extraordinary returns that we've all enjoyed over the last 3 years, pulled forward or borrowed from the future? So we'll talk about that in a little bit of detail, but we think the short answer to that question is yes. So where does that leave us today? Where are we now? We think we're at the point where, there's a price to be paid. It's time to pay the piper to some degree for our pandemic response. If there weren't consequences of, unrestrained money printing and very generous, stimulus payments, we'd never have another recession. We'd never have another equity market correction or a bear market, but there are consequences. And in the here and now, we're dealing with those consequences in the form of, 8% inflation, which is at more than 40-year highs. So Jay's going to talk a little bit more about this really important topic and some of our thoughts, but we do think that the direction of inflation from here is going to have a big impact and be a big driver on equity market outcomes for the rest of the year. Okay, so we have a fully recovered economy. As I mentioned, 4-decade highs in inflation. It's time for the Fed to start raising interest rates and normalizing, interest rate policy. In fact, we would agree with the view that the Fed should have started this process some time ago and is behind the curve to some degree. So right now, markets are anticipating that we see a total of 7 quarter-point interest rate hikes in 2022. There's a lot of time left to go in the year. A lot of things can change, but I think the main takeaway is that we are transitioning away from zero interest rate policy to higher interest rates and tighter, financial conditions. So yesterday, again, the Fed moved forward with the first interest rate hike in 3 years. They are ending their quantitative easing or bond buying program this month as well. The next step in their process will be to, reduce the size of this $9 trillion balance sheet. Now, we expect this process to be very slow and measured and incremental, but it will pull, liquidity out of the market. As I mentioned, when the Fed was increasing their balance sheet, we saw valuations go up. we think it's very logical to assume as the Fed starts to decrease their balance sheet that, valuations will be somewhat pressured on the downside. Fiscal stimulus has ended, and as a result, budget deficits are going to be much lower compared to the last 2 years. This is certainly no surprise to markets or to investors, but that tidal wave of support for the consumer and the economy has faded. So, the investment landscape is changing. As I mentioned, financial conditions are getting a bit tighter. The real question is, has this been priced into markets? Have valuations already reflected this change? And here we show, a 25-year history of a PE or valuation ratio for the S&P, and we can see that stocks have gotten a bit cheaper over the last 5 or 6 months. Valuations have declined by about 20%. So we've done some work there. We think that's a good thing, but we're not back to the point yet where, valuations are in line with long-term averages. So it's difficult to, pound the table and say that, all the bad news is in prices, or that even more negative, potential outcomes are already reflected in stock prices. So let me go ahead and pause for there. I'm going to turn it over to Jay, and he's going to spend some time on inflation and a bit of our outlook there.
All right, thanks, Dan. Appreciate it. Real quick, I also want to congratulate Charlie. I've been at Fort Pitt for about 8 years now. The last 3, I've been a partner with Charlie, and along with Mike, Ted, and Todd. I know Charlie has, treated us extraordinarily well, and I've probably learned more from him in the last 8 years than I did the prior 20. So thank you, Charlie. Appreciate it. All right, here's the fun part. Mike tells me this morning, Jay, nobody wants to hear about a yield curve. Seriously. People are falling asleep and, they don't know what you're talking about. I'm like, okay, I got this, Mike. I'm going to talk about something really exciting. It's going to be inflation. So, but in all seriousness, it is something that everybody's heard about in the last year, probably, and most of us in our lifetime have not experienced it before, or at least it's been 40 years since we really have experienced it. How it hasn't brought up its ugly head until now is sort of incredible, but here we are right now, and there's a number of reasons why this happens, or why it can happen. The first one, increase in money supply. Check. We've provided free money to institutions and individuals that have flooded the market through asset purchasing that Dan was talking about. And that money goes from the government to the banks to the people. So therefore, we have a ton of money chasing a little bit of product, and that starts inflation. Supply chain disruption. Check. We still have tankers that are out in the Pacific Ocean right now with our goods that everybody wants to buy. And a lot of that has been, caused by the COVID shutdown, and we haven't been able to work our way through that yet. I think everybody is trying to figure out ways to better handle this, but we haven't been able to figure it out completely yet. So it's adding to the problem. The third, government-sponsored unemployment. Bingo. I'd never thought something like this would happen. I just thought they did this in some of the European countries, and paid people just to sit home and take vacation. But here we are. And at first, I think it was a good thing. Nobody knew what was going on. It was a little bit of uncertainty. We didn't know how it was going to pan out at the end. But it probably went on a little too long, and now it's adding to the problems that we had before. We're millions of jobs lower than we were before the pandemic. People decided for one reason or another they just did not want to come back to work. They found something else to do. They just figured that, they liked the way it was for that year and a half, and they just have not come back to work. So we go to number 4, poor government policies. That doesn't happen. Like I talked about, extending the emergency unemployment was probably, looking back at it, a mistake. And we added another about $1.92 trillion into the system that we already added prior to it. So therefore, we have more money chasing the same amount of product. So that's why we're at the inflation rate right now of almost 8%. And that is our 40-year high, as Dan said. And I think it may take a little bit of time to work our way out of this. Let me give you you all know this, but I just want to put it up there so you can see where we've been the last year. Coffee up 92%. Good thing we own Starbucks. Way to go, Carter. Natural gas and crude oil, this is old. It's probably up 80% since I printed this 4 days ago. So used cars, they're more expensive than a new car because you can't get a new car. So it just goes down. Lumber actually came down. Lumber at one point was up almost 50%, so we're making headway there, so that's good news. And then at the bottom you have the CPI at 7.5, which is a tad higher right now. So we all know this. We see it every day, and there's good things along the way. First and foremost, we do expect this to subside eventually. We can't continue to go at this pace. It's not doable. So if you look at the graph, I'm not going to bore you with some of the ins and outs of it, but we're at a 7.9% now, and everybody believes, the experts believe, that over time we should get down to around 3.8%, which is still almost double where we've been in the last decade, averaging around 2%. So if we get down there, we'll be ecstatic. But a lot of things are going to have to change to get us there. It's basically the same graph of where they expect it to be in 10 years. That's a guess. They don't know where things are going to be tomorrow, let alone 10 years. But they have to put a number on it, 3.8. So if we could be at 3.8, like I said, we would be ecstatic. It would be awesome. Then I got one more. Actually, two more. Here are the job openings on the left that I was talking about. You can see prior to the pandemic, the number of jobs, and then where we're at now. I mean, what is that? That's almost a $6 million difference in jobs. Where are these people? What are they doing? Our unemployment rate is still extremely low, but I think it's, we may be using a different kind of math in the way we're figuring this out, because if 6 million people are not in the labor force, that's a big disconnect that we have. So that's something we're going to have to definitely work on as well as a country. So hopefully we can get some sort of normalcy back to where we were a couple years ago, and maybe some of these people will jump back into the market because businesses need it. Anybody in here wanting to build something or want to order a car or order something at a restaurant, you all know that there's it's hard to find people to work at these places. So, you know, we're hoping that we can get back to some sort of reality in that area. Existing family home sales prices continue to go up. We're at all-time highs. I know some of the numbers came out today, and we had historically high new buildings for houses. So people are still trying to get that in before rates go too high. Too high. I mean, you get a 4% mortgage now, people are like flipping out. You know, back in the Charlie, where was your mortgage? You were telling me like when.
13%.
Yeah. So, I mean, could you imagine now 13%? People would be they'd be losing their minds. So we, you know, we're at 4% right now, which is almost a point and a half higher than probably it was last year at this time. But it's still, all things considered, relatively low. And there we go. I don't think anyone's mentioned Russia tonight, right? Drink. So what's going on right now in Ukraine with the Russia and the supply? It's creating obviously a big problem too, and it's also going to create more to the inflation. It shouldn't be as much as what some people want you to believe, but it's definitely above and beyond everything else we've already talked about. It's going to add to it. It's going to cause problems. And probably the biggest problem, it's not oil or gas, it's actually grain. If you look at Russia and Ukraine combined, it's almost a quarter of all the grain in the world. So that is something that everybody's going to have to keep an eye on. And, you know, maybe we can increase our supply here, but again, that's going to be a hard thing to do. So other than the obvious of what's going on over there and the devastation, this is a big issue when it comes to the grain. The crude exports, as we can see, it's around 12%. It doesn't affect United States at all, really. We can make that up very easily between, well, here or the partners that we have in either side of the border. So that's not a problem. However, it's a huge problem in Europe. Germany gets almost 100% of their oil and gas from Russia. So if we wake up tomorrow and Russia decides to cut off the pipeline to Germany, that's just another domino effect of everything that could happen in Europe that then will bleed over to America. So that's very important there, and it's something that we need to look at, and hopefully over time in the next couple years, maybe within the next decade or so, we could transfer some of that energy supply from Russia to somewhere else so we don't get into this situation again. Mike, was that exciting enough for you? I mean,
Unbelievable.
Awesome. Awesome. All right.
Field curve, that was awesome.
Yeah, I mean, I heard about that for 3 years, so get away from that. But okay, well, thank you, and I'm going to turn it back to Dan. He's going to give us an indication of what's going to happen.
All right. I don't think too many people ever accuse Jay of being too optimistic, so let me go ahead and kind of wrap things up with our outlook for the year. So we started off the year, you know, economists had very optimistic expectations for GDP, you know, call it 3.5% to 4.5%, you know, well above trend levels for the U.S. economy. You know, given some of the things Jay talked about with higher inflation levels that look a little bit more stickier than they did 3 or 4 months ago, the spike that we've seen in commodity prices across the board, you know, those estimates look a bit too optimistic. So we would adjust our forecast down to maybe a little bit above that 2.5% range. But more optimistic on corporate earnings growth this year. We've been really impressed with how well corporations have managed their earnings and their profit margins over the last 5 or 6 quarters. Demand has more than offset the increase in their pricing, and we think we'll see another record year for stock buybacks, which should boost earnings. Stock buybacks could come at something like $1 trillion this year. So 10% earnings growth would equate to $230 in earnings per share for the S&P 500 index. Certainly not a bearish call. That's actually 2% above where current consensus estimates are right now. The other part of the component, what valuation multiple would we put on that? We're using a 19 times multiple, which is down considerably from where we were in the summertime, but it's also 10, 12% above long-term averages, which we think makes sense in a still fairly low interest rate environment. So if we take those two components, $230 in earnings per share times a 19 multiple, we get to an S&P target of 4370. That's actually down about 8% from where we closed out 2021, again, at all-time highs after, a 100% advance over the last 3 years, and about flat to where we closed out February. Some of the issues that certainly guide that view down a bit is, the pull forward of returns that I mentioned, higher interest rates, and tighter, financial conditions. A lot of wild cards out there, obviously. Jay mentioned what's going on in the Ukraine. We don't know how that's going to be resolved. Do we see tensions increase between China and Taiwan? Is the Fed, forced to raise interest rates too aggressively? So we don't know the answer to these questions, but we think the outcomes are going to be significant drivers of returns this year. And I think maybe the biggest or the most important point on this slide is that, we are not limited to the S&P 500 as our investment, option. We have much broader options than whether to invest in the S&P or not. And we see a number of things that have us, fairly excited this year. One being, historically wide valuation dispersions. And what does that mean? I think this chart really highlights it. So we can see in the green is the valuation of the overall market, but a very wide band around that in terms of valuations of individual companies within that index. There's a lot of stocks out there that are still very expensive, in our view, don't deserve to be priced as richly. And there's a lot of stocks that are extremely cheap, and we don't think they should be as cheap. So in our view, this sets up an opportunity for active managers and fundamental stock pickers like ourselves. And then finally, I'll wrap up with this. As you all know, we have a value tilt in portfolios. Not that we don't have any growth stocks, because we do, but we lean more heavily towards the value side, which has been beneficial recently. And we think that outperformance from value stocks can continue, given that value stocks trade as cheap compared to growth stocks as they have in more than 20 years. So certainly a lot that we're still very interested in and excited about. So with that, I'll go ahead and wrap it up. Bill, kick it over to you.
Thanks, Dan.
Absolutely.
All right, now we will open the floor to questions for about, 15 minutes or so. And the way it'll work, you raise your hand, I will pick on you, and then I have some colleagues out on the floor with microphones. They'll come over and you can say your question in the microphone. So, and also want to introduce Carter Henderson, who's going to join us on the panel here to answer any of these questions. So, fire away. Sir.
Can you hear me? Sorry, this question might come out of left field, but what long-term effects do you see on the market with cryptocurrency becoming more and more popular, more so with crowd loading, guaranteed high return?
I think I'll take this one, being that I'm by far the youngest one up here. But I would say, cryptocurrencies have a stigma, and they had a stigma as being an inflation hedge going into, inflation being out of control, and that has not worked at all. Over the last 4 months, it's lost a third of its value. I think there's no coincidence that Bitcoin and other cryptocurrencies have done so well, because over the last 10 years, we've seen a flood of easy monetary policy and free money that's flooded into the market that's pushed, to me at least, has pushed out speculation and risk curves for risk managers, asset managers, and individuals to take more risk in the market. Now, to me, I'll speak for myself as the younger one here. I do believe in the technology behind cryptocurrencies. What's going on with the blockchain and what you call proof of stake is very revolutionary. We've already seen that with smart contracts, and we've seen that with, the rise of NFTs. As for how it plays into the market, I don't think it's going to have any serious effect in the market, but as it becomes, I guess, more mainstream, it'll be adopted as just another asset class or another way to diversify your assets. And that's how I see it working in the market.
Thank you, Carter. Other questions? There have to be some questions. I know everybody's hungry. That's great too. But we see one.
Hello, good evening. Ex-military veteran here. Just a quick question. Given what's going on in Europe is very tragic, there's probably 50 to 100 countries lining up getting quotes for fighter jets right now. What's the firm's perspective on investing in aerospace and defense?
Yeah, I think that's a good question and certainly a timely one. And we do have a positive view on defense in general. We hold, two defense stocks. I think what we're really going to see is a lot of European countries, increase their defense budgets. We've already heard, Germany mention that they plan to spend another $100 billion on defense over the next 2 years. NATO, all the other NATO countries have pledged to really get serious about spending the 2% of their GDP on defense. There was just some news the other day about the European Union setting up some type of $2 trillion investment fund or borrowing capacity to invest in both defense and energy as well. So, we like the space. Certainly done well this year, but I don't think it's at the point where it's overdone or valuations are too expensive.
Okay. Yes, sir.
Curious what you think about oil in the near future.
Prices?
Well, stocks, oil and gas company stocks.
Yeah, I think we have some energy exposure. It's probably about in line with market levels. I think what investors probably need to keep in mind and not get too over their skis or excited about energy is that a lot of these businesses hedge their production. So when oil went to $120 or $125. That's probably not the price that the producers are getting if they hedge a significant amount of their exposure. And then the other thing I'd mention is, if you look out kind of the forward curve or where the market expects oil prices to be a year out, it's in the high 70s, low 80s. So the market is telling investors that $100 oil or $120 oil, probably isn't going to last for an extremely long period of time. We'll see if the market's right or not, but that's that's what's being priced in right now. So I think that's one point. The other point is, though, a lot of these companies have really strong balance sheets. They generate a ton of cash flow, pay very attractive dividend yields. So I think, a bit more of a neutral view here on energy, in my opinion.
Any other questions? Here we got one.
On the energy issue, how about alternatives to fossil fuels? How do you believe that is going?
In terms of alternative energy?
Right, like solar and wind and job creation.
Yeah, I think at the end of the day, we're not ready for that. And I think Europe, the infrastructure is not ready yet. And I think Europe is learning that lesson. As Jay mentioned, Germany is dependent on Russia for 50 or 60% of their energy exposure because they went down the path of renewables, green energy, and now they're heavily reliant on their adversary for their energy policy. So, not to say we shouldn't continue to invest in those assets and develop that infrastructure over time, but I think it's very evident what's going on right now that we're not there yet.
I'd add to that too. We've looked at the markets and stocks in general of, you look at solar panels, you look at wind turbines, you look at lithium batteries, you just see the companies that are actually supplying the fundamental uplifting to those companies, like nickel, like cobalt, like lithium, like nickel. I think those companies, especially commodities, are going to have a good future, especially when inflation rises. You think about any type of hard assets going to do pretty well. But I think if you wanted maybe indirect exposure to something along those lines, that's a good place to look.
Yes. So my question would be about the other green, marijuana. So we're looking that we are going to go recreational maybe in the next couple of years. Is that something that we or you would invest in?
Partake in or invest in?
Well, both, of course.
Yeah. It has definitely made a lot of headway in the last couple years, that's for sure. The banking regulations still are a little iffy. The companies I know, like Tilray and some of the other ones Canopy put a lot of marketing around it, and it really hasn't panned out. And I think a lot of it is too, it's just the guardrails that they put up. It's just as easy to go down the street and get it off your friend Bob and not have to pay taxes as it is to go to the store and get lined up with all of the taxes and regulations involved. So it's still in the process of getting itself worked out, I believe. But I think eventually it's going to end up being just like the beverage industry, maybe in a decade or so from now. But again, we're just not there yet. No.
Do you really think that the economy is going to go back the way it was, not only because of the pandemic, but the millennial kids, my own kids, they have a different approach economically.
Okay. Do we really think that the economy is going to come back because of generational changes and?
I think the economy in general, in terms of the overall GDP, is back to where we were and even higher. But there certainly has been a lot of dispersion among different segments of the economy between services and manufacturing. We've seen a lot of retirements, people that aren't coming back into the workforce. We've seen a lot of younger people disengaged with the workforce. I'm not exactly sure what changes that, but I think one factor would be higher wages. As Jay mentioned, we have a situation where there's more than 11 million job openings right now, a level that we've never seen before. How do you bring those disengaged workers back in? You've got to pay them more. So I think that's one component of inflation that's probably not going away in the near term.
And that's not really the question. The question is what my kids, one doesn't want a car. He has a very good job, very well paid, lives very well, but he doesn't want to have to be using a car. I have a granddaughter who is very entrepreneur. She doesn't want a car either.
So they don't want to drive?
They don't want to drive. They don't want to consume energy.
So they don't want to drive and they don't want to consume energy.
They don't want a car. They don't want a car. They don't want a car. Yeah. So we're going to go ahead and end the question and answer. We'll come over and address that specific question, and then if anybody else has one that didn't get a chance or was too shy to ask, we'll be around all evening, and otherwise you can certainly call or email your advisor tomorrow, and we'll be happy to give you our best thoughts. So thank you, everybody. Enjoy the party, and thanks again for coming.